I was staring at my screen, 7:12 a.m., coffee half cold. The number blinked and blinked again. Not huge, not newsworthy, not yet. But my stomach sank. Because this one small line told me the story most people were missing. Markets don't panic over headlines, they don't. They move over what goes unnoticed. And right now, something is shifting quietly. Beneath interest rates, beneath the chatter about inflation. You won't see it on TV. You won't read it in the morning newsletter. Silver, gold. They are already feeling it. Gold has been moving slowly. Silver, I swear. Silver is tightening in ways that matter, the kind you can feel if you're paying attention. The Fed says words like somewhat elevated, subtle, measured, but those words are heavy, and they're not alone. The industrial side, the demand side, smart money is noticing. Not all of it, not yet, but enough to change behavior. I keep staring. Blink, reread. Something is quietly breaking the rhythm of the market, and if you don't see it coming, you will only notice after it hits. Do you see it yet, or are you still looking at the surface? Last week, the Federal Reserve concluded its two-day meeting. The benchmark interest rate was held steady at the current range. No hike, no cut. The statement that followed noted that inflation remains somewhat elevated. Consumer Price Index data for February was released 2 days later. Headline inflation was 2.4% year over year. Core inflation, excluding food and energy, was 5.1%. Both numbers were consistent with the prior month, showing little change from January's 2.3% and 5.0% readings. Treasury yields moved slightly higher on the 10-year, from 3.95% to 4.02% over the course of the week. The 2-year yield remained near 4.68%. The U.S. dollar index, DXY, closed the week at 103.7, up 0.3 points from last Friday. Gold futures traded in a narrow range. The December contract fluctuated between $2,005 and $2,028 per ounce. Silver futures followed, ranging from $25.10 to $25.90 per ounce. Daily volume was above the 20-day moving average, but within historical norms. On the industrial side, reports show that global silver production for January totaled 59 million ounces, consistent with prior monthly averages. Industrial consumption, including solar panels, electronics, and EV manufacturing, was estimated at 61 million ounces, based on preliminary data from industry surveys. No single event caused an abrupt spike or drop in prices. Movements were gradual, measured, and largely aligned with expectations from the previous month. Compared to last month, the range of gold and silver price movement was slightly wider, but still within typical volatility for this period. In summary, Fed held rates steady. Language indicated ongoing inflation concern. CPI remained persistent but stable. Treasury yields modestly higher, DXY slightly stronger. Gold and silver traded in narrow ranges, with volumes above recent averages. Industrial silver demand exceeded supply slightly, continuing the trend observed in the previous months. All data points are confirmed, publicly reported, and time-stamped. There are no opinions or projections in this section. Holding steady rates and persistent inflation is more than a line in a Fed statement. It sets the tone for borrowing costs, investment decisions, and asset allocation. When the Fed keeps rates high, borrowing remains relatively expensive. Companies reassess capital projects. Consumers weigh loans and credit. That's the first order effect, measurable, immediate. Gold and silver respond within this framework. Gold, historically a safe haven, adjusts to the opportunity cost of holding a non-yielding asset versus government bonds. When yields remain elevated, gold faces modest headwinds. Investors might shift some capital into treasury instruments that produce positive real returns. That is one measurable impact. Silver reacts differently. It exists in the monetary space, like gold, but it also has industrial demand. Factories, solar developers, electronics manufacturers, they pull silver regardless of central bank moves. When production cannot meet consumption, the deficit grows. Industrial buyers may secure longer forward contracts. Lease rates for physical silver can rise. These are second-order effects. They are subtle, not in the headlines, but they influence available supply, margins, and pricing in tangible ways. The convergence of these two forces, monetary and industrial, creates a pressure point. If the Fed maintains restrictive policy while industrial demand keeps increasing, silver is simultaneously influenced by both streams. Gold sees one stream, silver sees two. That difference matters for anyone holding these metals. Consider timing. Large institutional buyers and industrial consumers act quietly before headlines show significant price movements. They adjust positions based on data like CPI persistence, treasury yields, and industrial procurement reports. When these actions accumulate, the market shifts before retail investors notice. Even small changes in supply or cost structures can propagate. If a solar panel manufacturer locks in silver for 6 months at slightly higher rates, that reduces available market supply. Futures spreads widen, lease rates spike. These are not speculative. They are the mechanics of supply and demand in real terms. The effect is not immediate volatility but structural pressure. Gold may fluctuate slightly, silver may tighten, and industrial buyers may react faster than investors tracking news. Over time, this layering of actions can magnify price movements once the broader market recognizes the imbalance. In short, the facts, Fed policy, persistent inflation, industrial demand exceeding production, create a chain of impacts. First order, borrowing and investment behavior. Second order, metal availability, industrial procurement, futures spreads. Investors, manufacturers, and analysts notice these layers differently. Understanding this sequence is critical to interpreting the market accurately beyond surface headlines. The last time we saw persistent inflation paired with restrictive interest rates for this long was roughly in the early 1980s. The Fed under Paul Volcker raised rates aggressively, keeping borrowing expensive for an extended period. Inflation was higher then, but the mechanism is similar. High rates alter borrowing behavior, capital allocation, and asset prices. Gold prices at that time reacted sharply to rate announcements and inflation data. Silver, though smaller in market size, experienced more pronounced swings due to industrial demand pressures. Mines and refineries struggled to match consumption, creating temporary imbalances in supply. Traders and industrial buyers adjusted ahead of headline news, often quietly, before broader market participants recognized the impact. Compare that to the late 2000s. Rates were low, liquidity was abundant, and central banks flooded markets with stimulus. Gold moved steadily upward, silver followed, and industrial demand played a secondary role. The dynamics were different. The driver was monetary expansion, not rate restriction. Industrial pressure existed, but was not compounded by monetary tension. Today, the situation shares some traits with both historical periods but differs in key ways. Inflation is persistent, not extreme. Rates are elevated, not at crisis levels. Industrial demand for silver is structurally high and global, fueled by technology, energy, and infrastructure needs. Supply deficits have lasted 4 consecutive years, a duration uncommon in modern history. Additionally, government classification of silver as a critical mineral adds a factor that did not exist in previous comparable periods. This introduces a structural demand layer separate from market speculation or investor sentiment. The lesson from history is not prediction, it is perspective. Markets under persistent rate pressure do not move uniformly. Assets like silver and gold may respond differently depending on overlapping forces, industrial usage, supply constraints, and regulatory classifications create dynamics that can amplify or moderate market reactions. In short, conditions today echo patterns from the past but combine elements: monetary restraint, industrial demand, supply deficits, government classification, that make the current environment unique. Understanding similarities and differences provides a framework to interpret market behavior without assuming history will repeat exactly. Bull case. If the Fed begins to ease monetary conditions over the next few months, reducing interest rates even slightly, then gold could regain upward momentum. Investors may seek safe haven assets as real rates fall. Simultaneously, industrial demand for silver continues to grow. Solar installations, EV production, data centers, and defense systems remain on track. If production does not accelerate to match consumption, then silver's structural deficit persists, and forward contracts may tighten. Under these combined conditions, silver could experience amplified upward pressure, stronger than gold, as monetary relief meets industrial scarcity. If key government programs continue to prioritize infrastructure and clean energy, then industrial demand could rise faster than anticipated. If physical inventory remains constrained, lease rates for silver might spike, signaling tightening supply even before headline prices move significantly. This would attract attention from institutional buyers, reinforcing market pressure. Base case. If rates remain largely unchanged and inflation stabilizes near current levels, then markets may continue to trade in ranges similar to recent months. Gold may experience mild fluctuations in response to Treasury yields, while silver's industrial demand maintains a steady influence. If production meets approximately 95 to 97% of industrial consumption, then supply deficits remain, but not at levels that provoke extreme price action. In this scenario, silver continues to respond to both monetary and industrial signals, but moves gradually. Investors and industrial buyers adjust positions incrementally. Treasury yields, DXY, and CPI readings guide marginal shifts rather than dramatic trends. Market structure remains intact, volatility remains moderate, and the convergence of forces produces measured, predictable adjustments rather than sudden spikes. Bear case. If inflation unexpectedly collapses or economic growth slows sharply, then the Fed may pivot to aggressive rate cuts sooner than anticipated. If real yields decline rapidly, gold may surge initially, but silver could face a different reaction. Industrial demand might weaken if production and investment slow due to economic contraction. If supply begins to exceed consumption in this scenario, structural deficits could ease, reducing upward pressure on silver. If new silver mining projects or recycling efforts accelerate, then forward-looking industrial contracts may loosen. Lease rates could decline, and market liquidity could increase. Combined with falling rates, this could temporarily reduce the urgency for silver accumulation, leading to consolidation or modest declines. Across all scenarios, the interaction between monetary policy and industrial demand remains the central variable. If one force dominates, then prices move in one direction. If both reinforce each other, then market pressure intensifies. The timing, magnitude, and coordination of these forces determine the trajectory, not a single event or headline. First, the US dollar index, DXY. A stronger dollar increases the opportunity cost of holding non-yielding assets like gold and silver. Small moves in DXY can ripple through the metals market, particularly when combined with yield movements. I watch daily closes, weekly trends, and deviations from moving averages. Next, Treasury yields, especially the 2-year and 10-year notes. The short end reflects Fed policy expectations. The long end reflects market inflation expectations. Yield curve behavior, steepening, flattening, or inversion, can indicate shifts in monetary conditions and influence investor positioning in gold and silver. Inflation data is another cornerstone. CPI and PCE reports provide confirmed information on price trends. I note monthly changes, year-over-year comparisons, and core versus headline inflation. Persistent readings near or above 2% influence central bank language and expectations. Even small changes in these numbers can alter the perceived urgency of rate adjustments. For the metals market itself, I monitor volume and liquidity. High volume without significant price movement can indicate absorption by institutional participants. Unusual spreads between spot and futures contracts can signal underlying supply tightness, as can spikes in silver lease rates. These are subtle signals, but they matter. Industrial positioning is critical. Forward contracts from solar, electronics, and EV sectors provide insight into physical demand. When industrial buyers extend contracts further or pay premiums, it indicates rising pressure on available supply. Finally, open interest and positioning in futures markets. Changes in large trader positions can show early shifts in sentiment and strategy. Combining this with other indicators, Treasury yields, DXY, and CPI offers a layered understanding of the market. I don't rely on headlines, social media chatter, or analyst speculation. These indicators tell me what's already happening in the market, not what someone hopes will happen. Watching them consistently allows me to see pressure points forming quietly before broader attention arrives. In short, these are the levers, the gauges, the metrics that reveal the real story behind gold and silver. DXY, Treasury yields, inflation readings, volume, spreads, industrial contracts, and open interest. Each one alone is a data point. Together, they create a picture of market forces at work. The story of gold and silver isn't built on headlines or sudden panic. It is built quietly from persistent forces, Fed policy, inflation data, industrial demand, and supply constraints. Each moves at its own pace, sometimes visible, often not. If you hold positions, the important part isn't timing the next news cycle. It's understanding the layers beneath. The structural deficit in silver, the industrial pull, the ongoing rate environment. These are the facts that quietly shape the market every day. Patience, attention, and measured observation matter more than reaction. Watch the indicators, note shifts, and maintain awareness of convergence points. This isn't investment advice. It's simply how I'm reading the market right now. Risk exists, opportunities exist, and outcomes are never guaranteed. But recognizing the forces at play allows you to make decisions with clarity rather than impulse.